So let's get into that, Ben. Let's get into Australia and do a really big deep dive.
Yeah, well, here we go. So, and normally by this time we'd probably go straight into the RBA announcement, but we're not going to do that because what we want to do is set a scene in terms of sort of what's been happening with the market, and then we can basically talk about what the governor and the board decided to do today. So we start where we started before for the other countries, and that is we're going to start with the inflation story. So we saw that the Australian Bureau of Statistics, they released, the inflation read, and so I'm going to tell you the year-on-year story here. So the year-on-year story is a reading of 3.6% for Q1 of 2024. Now, that's down from 4.1% in the previous period, and that was above market expectations of a 3.4% result. Now, this was the lowest figure since Q4 of 2021, as goods inflation eased for the sixth consecutive quarter, 3.1 versus 3.8 in Q4, and services inflation slowed for the third straight quarter, 4.3 versus 4.6. And we're going to come back to that one because it's still that number in the fours is still too high. Yep. So let's go through the breakdown in terms of some of those results so we can get some context. So inflation moderated for most components. So food, 3.8 versus 4.5. Alcohol and tobacco, 6.3 versus 6.6. Housing, 4.9 versus 6.1. Health, 4.1 versus 5.1. Transportation, 3.6 versus 3.7. Communication, 1.8 versus 2.2. Recreation and culture, 0.2 of 1% versus 0.5. And insurance and financial services, 8.1 versus 8.2. So that is still too high in terms of that. Now, in terms of, in the meantime, the cost of education accelerated. So that's 5.2 to 4.7. That's one of the ones that Evan was talking earlier about. Clothing rebounded, but only a small marginal 0.4 of 1% versus a disinflation of 1.1% in the last reading. And furniture and household services was slightly up at 0.2 of 1% versus a flat reading before. Now, in terms of the RBA's trend mean CPI increased to 4% year on year. Now, this is the softest rise in 2 years, but remained outside of the central bank's target of the 2 to 3%, which is what we chase here in Australia. So if I can quickly summarise before I hand over, when you look at the annual year on year, you can see we peaked out at 7.8 and we're on our way down, a slower way down. So if you look at those numbers, you're thinking, what's there to see here? But then you go and have a look at the quarter on quarter result, and we were surprised by the March result. So you can see there what it said, in terms of that quarter by quarter basis, inflation actually re-accelerated in that March quarter by 1% compared to the December quarter of 0.6. And the market had a reading, they were hoping only for a re-acceleration of around 0.8 on their forecast. So that is why the media had a field day in terms of what's happening with interest rates in Australia. So I'm going to hand over to you now, Evan, and sort of just talk us through the way in which you look at inflation and some of the breakdowns in terms of what you're seeing there.
Yeah, so this is why we wanted to do this deep dive, because it's super important to understand just how much and how big the dynamic actually is. And again, my term through this entire talk has been box of chocolates, because as Ben's highlighted with this chart here, that re-acceleration to 1% is an absolute headache for the RBA, because why it matters and where it comes down to are things like this: tradables versus non-tradables. We keep hearing around this idea that this is a supply-led inflation story, that we have issues around imported inflation coming from overseas, etc., and in there. The definition of tradables versus non-tradables, this needs to be pointed out very clearly. Tradables are anything, goods or services, that have input from international pricing. Non-tradables are those that don't. They're domestic-facing only products or services that we get here. So a good example, government and government spending and government increases. Things like health, things like education, things like rent. They are the things that are there. And this chart, what I wanted to show with you here, this is the 6-month average of those. And you can see that actually international competitive inflation, tradables, it's contracting on an average of 6 months. That's a really good thing to know, that inflation in that spot that had been a massive problem back in 2021, 2 and into 2023. We now, it's not this supply-led problem. it's a domestic story. And that's what the chart on the right is telling you, is that actually, and you heard it in Ben's numbers when he read out, you listen to things like financial services, you listen to things like education, like health. They're all sitting on average at about 4.5 to as much as 6%. And that explains why the average over the last 6 months is at 5.77%. And if you even just look at it from the point of view of just on what goes on straight month on month, yes, it's starting to fall away, but it's still sitting at 5% in the last read for what we just had in March. And that grey band, as Ben highlighted before, that's where the RBA needs inflation to be at, 2 to 3%. Again, tradables last month are at 0.9 of 1%. So those services, those goods providers that actually have to compete with international pricing, they're doing the right thing. They're back to levels that are much, much more sustainable. What this is telling me is that it's us. We are still doing things in this country that are keeping inflation going and going at quite a rip. And we know that. That's where this term cost of living is coming into it, because that's where it is. Non-tradables are the cost of living crisis we're facing. And that's where that 5% is, because we're our price takers as consumers. We have to accept the government charge we have to get. We have to accept the health price that we get. We have to, unfortunately, accept the rent or housing costs that we get. And this is the $64 million question as well, is how do you fix that? And we'll come to that in a minute. Because the final part of the story, again, is that you can split it all out, right? There's so many things going on inside of this. And this is another beautiful chart that came from IMF, which I thought was fantastic. So again, if you take the headline figure but exclude housing, insurance, financial services, which are massive components of the inflation story, we're actually back in target. We're sitting at 2.5%. If you again take headline and take alcohol and tobacco out, or take education, all of them tell you that actually once you get rid of what's referred to as sticky inflation, that whole story, we're back inside target, which is again why you keep hearing this discussion at the moment around why rate hikes could be possible, why rate cuts could be possible, because again, it's all on this concept that if you take certain parts of the inflation read, you can get a certain story. And it's why it's so messy and so noisy at the moment.
Oh, I think you did a great job there, Evan, in terms of talking to that story. I mean, we've got to remember that the RBA's job of what they're trying to do is they're saying we are on a transition. We're not going for a heavy, hard at it type of pull the brakes on and, hit the skids. What we're trying to do, or what they're trying to do, is this narrow path, right? So this Goldilocks scenario, not too hot, not too cold, where they can retain as many jobs as possible. So I think that's got to be playing on their mind in terms of, because they know obviously, further cuts is going to have an impact on that. So they've got to then say to themselves, well, what's going to happen in housing? What's going to happen in insurances? What's going to happen in financial services? Those really difficult ones that are still moving up quite high in terms of, will they in the next 12 to 18 months start to ease off as part of that particular story? So with that in mind, let's turn our attention to what the RBA and Governor did today in terms of Governor Bullock, and we saw she kept the rate on hold. So the RBA board decided to keep the rate on hold,